option whose strike price equals the face value of the debt. Equity holders on the other side have a long position in this call option, and if the firm is doing well, and if the firm value, which is on my horizontal axis here, is greater than the face value of the debt, then they will choose to exercise that call option, which is in the money. So their payoff function will look something like this. Now, on the other hand, bondholders will have an asymmetric payoff function because they receive fixed coupon payments. So no matter how large the firm value is above the face value of the debt, they will still get those fixed coupon payments. Okay, so only when the firm is doing bad, in other words, only when the asset value is below the face value of the debt, bondholders will incur a loss. And that drives us to predict that bondholders will be more worried about negative news as opposed to positive news. So we'll be worried more about the downside potential as opposed to upside potential of the company. So this very basic, simple framework helps us test several predictions. But the basic question we are looking at is the role of accounting earnings in the bond market. Accounting earnings is a summary measure of firm performance. How accounting earnings affects bond trades and how accounting earnings is priced in bond prices. Now, given the asymmetric payoff I just showed you, and given that we would expect bondholders to worry more about negative news as opposed to positive news, we predict in this paper that accounting losses will be more relevant to bondholders as opposed to accounting profits, but we also predict that accounting information, accounting earnings in this paper is more relevant when bonds are riskier. And by riskier, we mean that riskier bonds are more likely to have that option out of the money, are more likely to suffer losses. So here we see accounting earnings as a summary measure of firm performance, and we see current accounting earnings as providing information that updates bondholders' expectations about the probability of that option being exercised or not. Previous literature on this issue, I will start with the equity type literature. Hain in 95 and Burstaller and Dichev are the first ones to show nonlinear relationship between accounting earnings and equity prices. So they are looking at profits and losses. In particular, Hain finds that the equity market prices profits but not losses. And her explanation is that losses are temporary, so thus shareholders don't care about them. However, there is a growing research now, and Jusen Plesko is one example, in the accounting review, that finds that almost 40% of earnings in the CompuStat universe show a loss. So we have 40% losses in the CompuStat universe, so then what's the problem if the equity market doesn't care about losses? In the bond market, we have very limited evidence. Surprising, again, after so many years, and these are studies that use very small samples, 100 observations, and they're also looking at this link between earnings and bond prices. Now, to test our two predictions that losses are more relevant in the bond market and accounting earnings are more relevant when bonds are riskier, we employ two types of tests. We have a kind of a volume type test, so volume reaction test, and we call this frequency of trades test. Just as an aside, in the bond market, bonds don't trade every day. So it's not like in the equity market, and that's why we have to construct a measure that looks at the incidence of trade. The reason why they don't trade every day is because most of the bonds, with only a few exceptions, most of the bonds are traded on the over-the-counter market. And our second set of tests is more in line with the ERC type literature out there. So we are looking at the relationship between bond returns and earnings, and in particular whether this association is nonlinear or not. Okay, so let me discuss about our first set of tests. We identify all earnings, quarterly earnings announcements. We align all these announcements by event date. We look at days 30 days prior, 30 days after these events, and we compute an indicator variable that takes the value 1 if a bond issue is traded, and 0 otherwise. So the underlying assumption here is that we have a trade only if we have an information event behind that. So what we do next, we aggregate this indicator variable, we aggregate it across different bond issues and different quarters, and we scale it by another aggregate measure. This time we aggregate not only by issue and quarters, but also by the days in this event and non-event periods. Okay, and then to test whether, and then we look at the temporal behavior of this ratio, the percentage of bond issues that are traded in the event versus non-event periods, and we test whether there is any spike in the graph using this test statistic. Now, to mention something, we define event periods as the event period days +1 and +2, and these are days relative to the earnings announcements. Our second set of tests, probably you are more familiar with this now. Our dependent variable is the bond return, which is adjusted by US Treasuries. And to perform this adjustment, we match our bonds with Treasuries based on maturity and also coupon rates. And as an independent variable, we have earnings, and we scale earnings by the total firm value. And then we add interactions if earnings is negative or not, or if bonds are risky or not. And we define the riskiness of bonds using an indicator variable that takes the value 1 if bonds are speculative grade or not. How we compute bond returns? Have any questions? How we compute bond returns? The computation is similar to the computation of equity returns. It's just that here we also have to worry about accrued interest and coupon payments. Again, as I mentioned before, we adjust the raw bond returns by US Treasuries, which are matched by maturity and coupon rates. So the data, again, I was talking about this data. This data became recently available, maybe a few years ago. And we are using bond transactions data from the National Association of Insurance Commissioners. It seems that insurance companies are required to disclose these trades. And that's a bit of an issue. However, insurance companies hold almost 1/3 of the bonds, because that fits really well their portfolio. But the main advantage of our database, and I would like to emphasize this, is that we have actual transactions. Many other databases out there that provide bond prices like FT or Reuters or DataStream compute metrics prices. So these are prices computed by their models, and they compute a price even on days when no transaction occurred. And that's no good for us. Now there is a new database out there, and we are looking at this database now. And this is a requirement by the National Association of Security Dealers. All traders in the market are required, starting in 2002, to disclose their transactions in the bond market. Few comments about sample selection issues here, and we are aware of this. This descriptive statistics compare the sample we are using for our tests and the CompuStat universe. Now, the main observation here is that our firms obviously are much larger than the average firm in CompuStat. And that's obviously by selection. Not any company can access the public debt market. The second observation is that although in CompuStat 40% of earnings are losses, in our sample, because we have bigger companies which are supposedly better, only 17.5% report losses. So let's get to the results section now. So this first graph presents the temporal behavior of that aggregated ratio from the day -30. This is the trading day -30 to day +30. And we notice around earnings announcements, right after earnings announcements, we notice a noticeable increase in the incidence of bond trades. Now, obviously, we associate this with the information that is coming out in the market. Then what we do next, we split our observations, we split our sample into quarters that have profits and quarters that have losses. And we notice greater reactions for quarters that have losses, right? And the differences between the two spikes are significantly different. Yes? So the question was what's the reason of looking at profits versus losses and not unexpected earnings relative to a benchmark like IB's consensus forecasts, right? The reason why we are looking at this is because we are trying to test that asymmetric payoff function, and at the same time we are trying to provide complementary evidence to the Hayne 95 paper, which also looks at losses versus profits. Now, in the paper, we also have a sensitivity test that looks at IB's consensus forecasts, and we actually find that multivariate tests, bond returns earnings associations, that the results are robust. I'll get to that test if I have time. Now, to test our story in a stronger setting, we further split the data, and we condition on having a loss, and we look at risky bonds and investment-grade bonds. According to the asymmetric payoff theory that I just showed you, you would expect a greater reaction when bonds are riskier. Okay, when bonds are, the riskiness of the bonds indicates that that call option is more likely to be out of the money. And again, the differences between the two spikes are significant.
Florin, can I ask? This is a simpler question. Can you explain the main metric that you use, the incidence of trade, the 5 sigma thing? Give me a feel for what the left-hand axis is. I mean, what is 1.5? Sort of the benchline.
This is the percentage of bond issues.
So it is a percentage.
It's a percentage, yeah. So we are scaling that aggregate measure because we want to compare different graphs. So we want to have the same base.
So the unit of analysis here is the bond itself.
Percentage of bond issues that are traded around earnings announcements, or on any on any date before or after earnings announcements.
So some companies have multiple issues.
Yes.
How is that handled?
It's not handled in our statistic. It's not handled in our statistic.
Oh, okay.
But that's a good point. I think we should look at that. In multivariate tests, we control for it, and I'll tell you how we control, but in these graphs, we don't. Yes? So the question is whether the raise starts before the earnings announcement or not. We are looking only on days for days +1 and +2, and we do that for all our graphs to be consistent. And now it seems that this graph has a peculiar shape here, but probably the increase starts before, but we didn't test for it. But I guess this is the only graph that shows this pattern. You see, again, this is a bigger sample for profits, and we don't see that pattern. So we believe there is, at least, maybe I can claim here, that there's nothing associated with this profit. Now, next we are moving to multivariate tests, to bond returns earnings associations. And we start with a very basic specification. Do bond returns incorporate information in accounting earnings? Here we are using accounting earnings levels. Now I'll show you some sensitivity tests in which we are looking at changes or changes relative to an earnings benchmark like IB's consensus forecast. So here what we find is that there is a very strong association between accounting earnings and bond returns. And just to mention how we estimate these regressions, first we have year fixed effects to control for macroeconomic factors that are not associated with interest rates, because we control for interest rates in the dependent variable, but are associated with bond returns. And second, because we have multiple issues, we cluster the standard errors at the firm level. Okay, so we want to avoid misspecifications of standard errors. But our main finding here is that the relationship between earnings and bond returns is driven mainly by losses. Here we find a significant coefficient at 1%. Again, standard errors are clustered at the firm level. And what we do next, again, we find that earnings become more important when bonds are riskier, and we further expand the model by having this interaction between the loss and speculative, and we find that there is, although the coefficient is not significant at 10%, if you use a one-tail, it is significant, but most importantly, the earnings loss result is still robust. What we do next, well, it might be because we aggregate components of earnings. Why not look at components? Why not look at cash flows versus accruals? And that's what we are doing, and we find actually no difference between the two coefficients. So the bond market looks at cash flows and accruals, and they are both priced in bond prices, which is, I think, quite interesting. Probably finance people would expect cash flows to be more important. Now, we are running a series of sensitivity tests to avoid misspecifications, model misspecifications. We are looking at earnings changes and changes in its components. We are looking at persistent losses, so we expect stronger results if losses are persistent. Again, we are looking at sample selection issues. As I showed you, we have bigger companies in this sample. So what we are doing, we are replicating Haynes' result, and hopefully we actually find the mirror image. So in her case, losses are not priced, but profits are priced, and that's what we find. And finally, we control for contemporary stock returns to see whether accounting losses provide information which is incremental to the information aggregated by the equity market. So let me show you these results. In this sample, we are selecting only the loss observations, only the loss years. And we add an interaction variable, transit, which takes the value 1 if losses are considered transitory, and we consider losses to be transitory if in the previous year we had a profit reported and 0 otherwise. And we actually find that persistent losses have a greater coefficient, right? So the transitory interaction is negative, and we find that is actually driven by the fact that if bonds are riskier or not. And this setting kind of confirms that the permanence of these losses drives our results, and that gets closer to our theory, to the theory that we use to support our tests. We run these specifications in earnings levels, earnings changes. Again, the issue we had here is that we don't have a theoretical model to tell us what empirical model to use. So that's why we use levels and then changes separately. We replicate Haynes results, and we actually find, and this is to check whether we have something specific with our sample, some sample selection issues, and we actually replicate her results, so we feel very comfortable about this. And third, we control for stock returns, and our results are still robust. Some other unreported tests, we look at volume data. The database provides information on the value of the transaction, but that value includes not only the price of the bonds exchange, but also the transaction costs. So that kind of induces some measurement error in our volume measures. Nevertheless, we compute the volume, we back out the volume using this information. And secondly, it is possible to have transactions on the same day between two insurance companies. So we want to avoid double counting here. So we develop an algorithm that checks whether the two transactions come from the same trade. We are also looking at bond liquidity issues. We drop bonds that are not liquid from our sample, so we select only the most liquid bond issue. Or if a company has several bonds, we compute a value-weighted portfolio return, bond portfolio return, and we replicate our results. And finally, we use an expectation model, and again, find similar results. Conclusions. This was a fast presentation, as you can see. We find large trading reactions around earnings announcements. And we think this provides evidence that earnings information generates traders in the bond market to update their beliefs. We also find that accounting earnings, basic question here, accounting earnings is priced in bond returns. We find that accounting earnings is more important when bonds are riskier. And finally, losses are more value relevant than profits. So what are our contributions? We think we are the first to examine this relationship between bond prices and earnings in a large sample study. We provide evidence that supports the Haynes result, complements the Haynes result in the bond market. And finally, and I find this very interesting, given that Haynes finds that losses are not priced in the equity market, then why do managers worry about avoiding losses? Here we find an alternative explanation to this loss avoidance phenomenon. It might be that managers try to avoid losses because they depress bond prices. Comments? So the question is whether yeah. So Phil is asking whether there are other measures that affect market prices, like bond prices, and what is our definition of cash flows, and whether that confirms with the cash flow measure that is used by Moody's. We didn't see what Moody's is doing. Obviously, Moody's is using EBITDA. I noticed that, and that's pretty common in the market. We are using cash from operations to define our cash flow measure. Maybe a better measure would be to have free cash flows. Other measures that affect market prices, bond market prices, we agree there are so many other measures. You can have a bankruptcy model. You can test the bankruptcy model. Maybe that's more relevant, let's say. But the purpose of our paper is to see whether earnings, which is a basic accounting number, provides information to the bond market. We only explain 12% of bond returns, of the variation in bond returns. So definitely I agree with you. There are other variables that explain the rest. It's just that that's not the purpose of our paper. Yeah. Rodrigo, go ahead.
I wonder if you separate this and the exactly react. I would think that there seems to be benefits of zero
So Rodrigo is asking whether we should separate in our sample to flex somehow companies that have negative book equity. My comment to this is that I don't expect to have any of these cases in our sample. Keep in mind, we have very large companies here, but that's possible. Or small book equity, yeah. that's something we can look at. Thanks. We actually do that. We actually do that in one of our tables. So we control for stock returns and we find that the results are robust. Now, one of your comments was that...
Can you repeat the question? Sorry.
Yes. One of his comments was that obviously the bond market anticipates earnings announcements, and I fully agree with you. That's why in our tests, we are focusing on long windows, not short windows. And obviously, and there is that research in the early 90s, Doug Skinner in 94 has a paper that shows that managers preempt bad news and they try to guide market expectations. So obviously the bond market will react to this kind of news before the earnings announcement. But that doesn't mean that we don't have an earnings announcement. But again, in our association tests, we look at long windows. Yeah. So the comment is that the database also has information on buys and sells, so you can actually see the direction of the trade. And why not use that information to test? In this setting, maybe you have more buys or sells around earnings announcement, conditional on reporting a profit or a loss. We actually did that in earlier analysis, and we found that actually around losses you have more sales. But keep in mind, these are from insurance companies. So this is a subset of the bond market. And obviously, you have a buy on the other side. But that may be because maybe insurance companies have to meet some regulatory requirements, and maybe they cannot keep bonds with certain properties in their portfolio. But we can expand the analysis to also look at buys and sells, because that's very interesting information that, unfortunately, we don't use in the current version. Right? Yeah. Yeah, that's right. That's right. Yeah. So Ray is suggesting that given that we are controlling for stock returns, we shouldn't get... So let me go back to that table. Here, given that we are controlling for stock returns, and this is a summary measure that should include all the information, including earnings losses, we shouldn't get any effects here. Now, the question is, as Hein documented, stock returns don't price information in losses. So, as you suggest, there might be a nonlinear relation between bond returns and stock returns. Yeah, yeah. My expectation here is that the markets must be integrated, right? So the information that is in the equity market should be also in the bond market. So I agree with you that. Yeah, that will be actually in the next version of our paper. So we are also thinking to interact the stock returns with the loss variable to see what happens. Yeah, that's a very good suggestion. Thanks.
Can you help me understand these basic magnitudes of these coefficients? Just what does, in the original regressions, what was 0.3 and 0.6? How do I interpret those? And do those make sense in the context of a present value model?
That's a very, to be honest.
Repeat the question.
So the question is, how do we interpret the economic significance of these coefficients in this context? And I think that's a very good question. We thought about it, and we are working on this now. We don't have a model, like an empirical model, that supports our empirical tests. And maybe that model will give us an indication as what would be the expected magnitude of the coefficient. We don't have that. What I can tell you is that the size, the magnitude of these coefficients is consistent with the magnitudes we see in the equity market. Usually we see coefficients, especially if you have a pooled sample like this one, over many periods, coefficients are usually below 1. And there is a lot of theory, at least in the equity market, and many people would expect these coefficients to be larger and to reflect the proper cost of equity capital. Honestly, I have absolutely no clue what the magnitude of the coefficients should be here. Okay, so I guess, yeah. Thanks a lot for your comments and for your interest in the paper. And if you have other comments, please let us know. Thanks.